Hello, hello. Welcome to Latest Wealth. In our online classes, we have been learning about technical analysis. My dear friends, in earlier we discussed little bit basics, different chart types, single candles, and spinning tops, and doji. Now let us learn about this is part 3 of single candlestick patterns, part 3. One is paper umbrella. The paper umbrella is a single candlestick pattern which helps traders in setting up directional trades. The interpretation of paper umbrella changes based on where it appears on the chart. Different places, different meanings it will give. So follow carefully. This is called paper umbrella. A paper umbrella consists of two trend reversal patterns, namely hanging man and the hammer. Hanging man pattern is bearish. Wherever hanging man comes, that means market may be going to be bearish. The hammer pattern is relatively bullish. When the hammer pattern comes, that means market may go in bullish trend. Actually, paper umbrella, how you can find out the paper umbrella is long lower shadow with a small upper body. If the paper umbrella appears at the bottom of the downward rally, it is called a hammer. If the paper umbrella appears on the top of an uptrend rally, it is called a hanging man. To qualify a candle as a paper umbrella, the length of lower shadow should be at least twice the length of real body. Let me repeat. To qualify candle as a paper umbrella, the length of the lower shadow should be at least twice the length of real body. This is called shadow to real body ratio. Let us look at this example. Open is 100, high is 103, low is 94, close is 102. It is for bullish candle. Here the length of the body is close minus open, that is 102 minus 100, that is 2. And length of the lower shadow, open minus low, that is 100 minus 94. 6. As the length of the lower shadow is more than twice the length of the real body, hence we can conclude that paper umbrella has formed. Now let us go into one more topic called hammer formation. The bullish hammer is a significant candlestick pattern that occurs at the bottom of the trend. You know, the hammer consists of a small real body at the upper end of the trading range with a long lower shadow. It looks like a hammer. The longer the lower shadow, the more bullish the pattern. Just look here. Presence of two hammers formed at the bottom of a downtrend. See, when the hammer is formed, the trend started changing. After the hammer, there is a bullish trend. Notice the blue hammer has very tiny upper shadow, which is acceptable considering the be flexible, quantify and verify rule. A hammer can be any color as it does not really matter as long as it qualifies the shadow to real body ratio. However, it is slightly more comforting to see a blue colored real body. The prior trend for the hammer should be a downtrend. The prior trend is highlighted with curved line. The thought process behind the hammer is as follows. 1. The market is in downtrend where the bears in absolute control of the market. 2. During the downtrend every day, market would open lower compared to the previous day's close, again closes lower from the new low. On the day hammer pattern forms, the market as expected trades lower and makes new low. 4. However, at the low point, there is some amount of buying interest that emerges which pushes the prices higher to the extent that stock closes near the high point of the day. 5. The price action on the hammer formation day indicates that the bulls attempted to break the prices from the falling up further and were reasonably successful. 6. The action by the bull has the potential to change the sentiment of the stock. Hence, one should look at buying opportunities. Now the trade setup for the hammer is as follows. Just follow this type. One is the hammer formation suggests a long trade. 2. The trader's entry time depends on the risk appetite of the trader. If the trader is risky taker, he can buy the stock same day. Remember, the color of the real body in hammer does not matter. Hence, there is no violation of rule number 1. If the trader is risk averse, he can buy the stock the day after the pattern has formed, only after ensuring that the day is a blue candle day. Once again, there are different options. One is risk takers can qualify the day as a hammer by checking following condition at 3:20 p.m. on the hammer day. Open and close should be almost same with 1 or 2% range. Lower shadow length should be at least twice the length of the real body. Next, if both these conditions are met, then the pattern is hammer and then risk taker can go long. The risk averse trader should evaluate OHLC, opening, high, low, closing data on second if it is a blue candle. The trade is valid and hence can go long. The low of the hammer act as a stop loss. The low of the hammer act as a stop loss for the trade. The chart, just look at the chart. It's a formation of hammer where both risk taker and risk averse could have set up a profitable trade. This is actually 15 minutes intraday chart of Sipla. Just look at the Sipla. Both would have made profit. Now, the trade setup would be as follows. Buy price for risk taker. What is the buy price for risk taker? He takes the trade on the hammer candle itself at rupees 444. What is the buy price for risk averse? He takes the trade on next candle after evaluating that the candle is blue at rupees 445.4. Now the stop loss for both traders is rupees 441.5, which is the low of the hammer formation. Have you noticed how the trade is evolved, yielding a desirable intraday profit? Let's go into one more chart. Here is a chart where the risk averse traders would have benefited by the virtue of buy strength and sell weakness rule. Just look here. One more chart we want to show, very interesting chart with two hammer formations. See here, there are two hammer formations here. Here is one hammer formation. Here is also one more hammer formation showing downtrend. Both hammers qualified on the precondition of hammer. That is, one is prior trend to be downtrend. Next, shadow to real body ratio. See here, prior trend is also down and here is also downtrend. On the first hammer, the risk averse trader would have saved himself from a loss making trade, thanks to rule number 1 of candlestick. However, the second hammer would have enticed the both risk averse and risk taker to enter the trade. After initiating the trade, the stock did not move up. It stayed nearly flat and cracked down eventually. Please note, once you initiate the trade, you stay in it until either of the stop loss or the target is reached. You should not tweak the trade until one of these events occur. The loss in this particular trade, first hammer, is inevitable. But remember, this is a calculated risk and not a mere speculative risk. Here is another chart where the perfect hammer appears. However, it does not satisfy the prior trend condition, hence it is not defined pattern. See that perfect hammer. Now let us go into one more pattern that is called hanging man. If a paper umbrella appears on the top of the end of a trend, it is called hanging man. The bearish hanging man is a single candlestick and a top reversal pattern. A hanging man signals a market high. The hanging man is classified as a hanging man only if it is preceded by uptrend. Since the hanging man is seen after a high, the bearish hanging man pattern signals selling pressure. That means it is saying that selling pressure. This is of Bank of Baroda. Just see here, a hanging man can be of any color and it does not really matter as long as it qualifies shadow to real body. The prior trend of the hanging man should be an uptrend. Please remember, hanging man prior trend should be uptrend. Just look here. The thought process behind the hanging man is as follows. One is, the market is in uptrend, hence the bulls are in absolute control. That means everybody is bullish and everybody thinks market sentiment is positive. The market is characterized by new highs and new lows, higher lows. 3. The day hanging man pattern appears, the bears have managed to make an entry. This is emphasized by long lower shadow of hanging man. 5. The entry of bears signifies that they are trying to break the stronghold of bulls. Thus, hanging man makes a case for shorting the stock. The trade setup would be as follows. Now you can follow this trade setup. For each risk taker, a short trade can be initiated the same day around closing price. For the risk averse, a short trade can be initiated at the close of the next day after ensuring that red candle would appear. Actually, the method to validate the candle for the risk averse and risk taker is exactly the same as explained in case of hammer pattern. Do you remember in hammer pattern we have explained the case? Same the way, my friends, once the short has been initiated, the high of the candle works as a stop loss for the trade. Just look at the chart. This is for BPCL Limited, has formed hanging man at 593. The OHLC details are open 592, high 593.75, low 587, close 593. Based on this, the trade setup would be as follows. The risk taker initiates the short trade on the day the pattern appears at 593. The risk averse initiates the short trade on the next day at closing price after ensuring it is a red candle day. Both the risk taker and the risk averse would have initiated their respective trades. The stop loss price for trade would be the high price, that is above 593.75. The trade would have been profitable for both risk types. Let me share my experience with the paper umbrella. My dear friends, while both hammer and hanging man are valid candlestick patterns, generally my dependence on hammer is a little more as opposed to hanging man. Are always almost equal, you can say. If there are two trading opportunities in the market, one based on the hammer and another based on hanging man, I generally prefer to place money on hammer only. The reason, simple. It's my previous experience in trading with both patterns. Only concern with the hanging man is that if the bears were indeed influencing during the day, why did the price go up after making a low? This, according to me, establishes bull's supremacy in the market. Generally, I would encourage you to develop your own thesis based on observation. Please remember, follow your own style, follow your own strategy, follow your own analysis that you make the market. This will not only help you to calibrate your trade more accurately, but also help you to develop structured market thinking. It comes by the practice. Next, let us go into one more pattern, that is shooting star. The shooting star is the last single candlestick pattern that we will learn about before we move to multiple candlestick patterns. The price action on the shooting star is quite powerful, thus making the shooting star a very powerful candlestick pattern to trade. The shooting star looks just like an inverted paper umbrella. It is just like an inverted paper umbrella. Unlike paper umbrella, the shooting star does not have a long lower shadow. Instead, it has a long upper shadow where the length of the shadow is at least twice the length of the body. Please remember, it is almost like a double the body size. The color of body does not matter, but the pattern is slightly more reliable if the real body is red. The longer the upper wick, the more bearish is the pattern. The small real body is a common feature between the shooting star and paper umbrella. Going by the exact definition, the shooting star should not have a lower shadow. However, a small lower shadow as seen in the chart above is considered alright. The shooting star is a bearish pattern, hence prior trend should be bullish. The thought process behind the shooting star is as follows. The stock is in uptrend, implying that the bulls are in absolute control. When the bulls are in control, the stock or the market tends to make new high and higher low. On the day of shooting star pattern forms, the markets, as expected, trades higher and in the process makes a new high. However, at the high point of the day, there is a selling pressure to an extent where the stock price recedes to closer near the low point of the day, thus forming a shooting star. Next, the selling indicates that bears have made an entry and they were actually quite successful in pushing the prices down. This is evident by the long upper shadow. Next, the expectation is that the bears will continue selling over the next few trading sessions. Hence, the trader should look for the shorting opportunities. Take a look at this chart where shooting stars has been formed and right at the top of uptrend. The OHLC data on the shooting star is open. Let us see. Open is 1426, high is 1453, low is 1410, close is 1417. The short trade setup on this would be like this. The risk taker will initiate trade at 1417. Basically, on the same day the shooting star forms. The risk taker initiates the trade the same day after ensuring that the day has formed a shooting star to confirm this trade as to validate. To confirm this trade as to validate, one is if the current market price is more or less equal to low price. The length of the upper shadow is least twice the length of the body. Next, let us come to risk averser. The risk averser will initiate the trade on the next day only after ensuring that second day red candle is formed. Please remember, once the trade has been initiated, the stop loss is to be placed at the high of the pattern. In the case, stop loss is 1453. As we have discussed before, once the trade has been set up, we should wait for the either stop loss or the target to be triggered. It is advisable not to do anything else except for maybe trailing your stop loss. Of course, we still have not discussed about trailing stop loss yet. We will discuss in next class. My dear friends, just look at the chart where both risk and risk averse would have made a remarkable profit on trade based on shooting star. After the shooting star, just see. Here is one more example where the both risk averse and risk takers would have initiated the trade based on a shooting star. However, the stop loss has been breached. Do remember, when the stop loss triggers, the traders will have to exit the trade, as the trade no longer stands. More often than not, exiting the trade is the best thing to do when stop loss triggers. My dear friends, let us revise what we learned today. 1. A paper umbrella has a long shadow and a small real body. The lower the shadow and the real body should maintain the shadow to real body ratio. In case of the paper umbrella, the lower shadow should be at least twice the length of the real body. 2. Since the open and close prices are close to each other, the color of the paper umbrella should not matter. 3. If the paper umbrella appears at the bottom of the downtrend, it is called hammer. If the paper umbrella appears at the top end of the uptrend, it is called hanging man. 5. The hammer is a bullish pattern and one should look at buying opportunities when it appears. 6. The low of the hammer acts as a stop loss price trade. 7. The hanging man is bearish pattern which appears at the top end of the trend. One should look at selling opportunities when it appears. The high of the hanging man acts as stop loss price for the trade. 9. The shooting star is a bearish pattern which appears at the top end of the trend. One should look at shorting opportunities when shooting star appears. 10. The high of the shooting star will be the stop loss price of the trade. My dear friends, hope you learnt something about technical analysis. You are going one step further in technical analysis. My dear friends, let's learn step by step. Don't be in a hurry. If you are unable to follow, watch once again with more concentration. Please remember, more you enjoy the process, more results you are going to get. So enjoy the process, enjoy the life, be wealthy. Let's meet in next class. Till we meet again, enjoy every bit of life. Have a nice day. Bye bye. Thank you very much. And Kailash is logging off.